We have just published our FX outlook for the second half of 2025, and here is a quick take. Now, in a nutshell, the dollar's downtrend remains intact, but the path could come a little choppy and uneven, with risk that shouldn't be ignored. Now, the dollar has seen one of its worst first half performances in more than 5 decades. Unlike 2024, which was defined by the US exceptionalism and tariff fears, the story in 2025 is a diversification away from the dollar. Now, there has been a steady erosion in confidence. In particular, the policy unpredictability with Trump's tariffs, concerns around US fiscal sustainability, and signs that the global reserve managers are reducing their dollar exposure. We are now in the early stages of what looks like a fundamental shift, not just cyclical dollar weakness. Now, the Fed potentially resuming its easing cycle later this year adds to the bearish dollar case. We remain constructive on euro, the yen, and the sterling pound. For euro, the European and German fiscal stimulus and reserve diversification trends out of the US dollar are building a solid case. ECB nearing the end of its easing cycle, the ECB officials appearing comfortable with euro's broad appreciation trend, and the increasing role euro could play as a global reserve currency may continue to fuel demand for the euro. A potential peace resolution in Ukraine at some point may even add to further upside. For the dollar yen, as the Fed BOJ policy divergence grows, with BOJ hiking rates and the sell dollar narrative continues, the yen remains a call long. Now, for the sterling pound, while domestic fundamentals are mixed, the UK-US trade deal removes tariff overhangs, and the pound is still an attractive DM carry for now. In Asia, North Asian currencies outperform. The Taiwan dollar, the Korean won, and the Japanese yen led the pack. Now, 3 drivers stood out in particular. Foreign inflows are returning to some parts in Asia, including Taiwan, India, and Malaysia. Now, trade tensions appear to show tentative signs of easing, with US agreeing to trade deals with China, Vietnam, and still in discussion with many others, including Korea, Malaysia, and Thailand. Exporters in the region are also rushing to offload some of their dollar holdings, while fund managers around the world continue to increase their hedge ratio, all in the light of reducing some of their dollar exposure. Taiwan dollar's sharp rally in early May was a reminder to those holding the dollars to diversify. Korean won also looks strong post-elections, with political stability and fiscal stimulus in focus. Tech stocks rebound, potential trade deal with US are other drivers that may continue to support Korean won's gains. Now, we are neutral on the Singapore dollar from a trade weight perspective, given its proximity to the Singapore upper bound. But on dollar Sing, there is room for the pair to head lower due to softer dollar. Now, the Malaysia ringgit may continue to benefit from softer dollar and steady China momentum. On the flip side, IDR and the Thai baht could lag due to domestic uncertainties and somewhat weaker fundamentals. Now, the main risk that could disrupt the sell dollar trade include: 1. If we do get another flare-up in Middle East tensions that may pose supply-side issues or drive up energy prices. 2. Further tariff uncertainty resulting in global recession. Or even 3, a sudden return of US growth outperformance. But barring those, the macro environment still favors dollar softness, with gold and silver also benefiting as anti-dollar trades. So in short, our view is to stay short the dollar, favor euro, yen, and sterling, and be selective within Asia. Korean won, the Taiwan dollar, and the Malaysia ringgit offer better prospects.